All right, everybody, this is your Lemonade Q4 and 2026 guide preview video. We got a lot to cover in this video. I've been excited about this upcoming earnings for Lemonade for quite some time, for even since last summer. So 6, 7, 8 months ago, I've been looking forward to this specific earnings because I think there's going to be special guidance. I think they're going to be sort of a special turning point for the company. So we're going to cover all the ins and outs of all those details in this video. Not financial advice. I don't know how the market will react. I give some of my own speculation or thoughts closer to the end of the video, or I will do that. But let's dive into it. So first of all, let's look at the guidance we have. Let's focus first of all on Q4, and then afterwards we'll look at 2026. But first of all, for Q4, let's look at what management is guiding. They're looking at a high end of in-force premium, 1.223 billion, revenue of 222 million, adjusted EBITDA loss of 13 million. So pretty strong numbers, even their guidance. They have a history of nearly always meeting or beating their guidance. And so what am I modeling for Q4? If I flip to my Lemonade model for my expected IFP, I'm looking at a 31% growth, which would be 1233, a little bit better than where they're guiding at 1223, about 10 million beat, 31% growth. The growth has been accelerating. It was 29% year over year in Q2, 30% Q3. So I'm looking at 31% in Q4. And this makes sense. Other commentary management has given, they said a sort of official number of 30%, but if you look closely at some of the earnings calls, they've sort of let it slip, the low 30s. That could be expected growth range in the coming year. So in the low 30 range here, 31% is what I'm looking at. I have revenue of 221 million, just at the upper end of where their 222 million range comes in at. Now, we look at their loss ratio. I'm saying a gross loss ratio of 59%. So I think it's possible. It might be 60%, but I'm going to say have fun and say I think they get into the 50s, 59%, make a statement there. And gross loss ratio, how could they get that low? Well, gross loss ratio in last quarter was 62%, and if you extract out what they define as catastrophic events from the quarter, they're at 56%. So I'm saying 50. Where was I here? I'm saying 59%, because a couple reasons. I think the catastrophic portion in Q4 is going to be really low. Okay, here's why. If you look at Progressive, some numbers for Progressive, they released their numbers, already released their numbers for Q4. Month by month, they released them, couple months delayed. And their catastrophic event or catastrophic factor loss ratio, that portion as a whole company, was less than 1%. In Q4. The quarter before was also very strong. It was only 1%, but then you had 3, 5. They have some quarters where you have a lot of losses. You have 7, 3%, and the property portion only, which is the majority of where your cat losses are going to come from. They've had 20%. They had a 75% quarter once just in property. It's a huge, storm losses, but that was only 0.5%. So super, super low. Super quiet quarter for cat losses. If we look at the earnings call from Q3, Daniel Schreiber said, if nothing unexpected happens in the coming weeks, I anticipate that we will set new records once more this quarter, Q4. And for that, he's talking about their loss ratio, both from a trailing 12 months perspective and from their gross loss ratio of 62%. So how much are you going to beat 62% by? I'm not sure, but I'm going to guess. I'm saying, hey, the underlying gross loss ratio ex-cat went from 68, 62, 59, 60, 56. I'm saying that's going to continue to slightly improve. Maybe they get to 55, maybe they get to 54%. And then you tack on last quarter was very low cat, and it was 4% cat. You're probably going to have that or less. So maybe this is 55% and this is 4% again, well, that gets you 59%. Maybe this is 55% and this is 3%. I'm actually a little bit too bearish and I should knock it down to say a 58%, something in that range. But I'm saying 59% based on that kind of reasoning. I explained that in on Twitter X post here that I think there's a pretty good chance, based on this evidence, that we'd see less than 60% as a loss ratio. So that's what I'm plugging in there. Now, if we think about how much marketing spend they're going to have in Q4, this was also on the earnings call last from Q3. Tim said, let's look here, move this along. If we look at, he's saying we'll probably spend similar in Q4 growth spend. That's what they're specifically the sales and marketing portion that is actually being spent on advertising. That is really moving the needle on reaching customers, not the sort of overhead portion that is much more fixed. But he's saying that portion, that growth spend portion, will similar spend to Q4 and probably spend about $180 million for the year. So what I'm modeling then next, if I can find it here, I'll scroll up a little bit. So at 59% gross loss ratio is what I'm estimating. If I'm having, I have 46 million in growth spend, and that's 46.5 million actually, very in line with the previous Q3, and you're at 180 million there for the entire year. I also have plug in what I'm expecting as customer churn, 17%. That's a little bit higher. It was more in the 16% range. In 2024 it was even higher. If we scroll back several years, it was a big issue, and they had more just purely renters customers or more transient. The book was much newer. So we have more stable customers that have been there longer. This has improved. But you also have some non-renewing of customers that has occurred over the last couple years, and that's going to affect your churn especially over a 12-month basis. So I'm going to think it was 18%. It's been slowly improving. I'm putting that at 17%. I think it's going to, I have 16.5%, 16% in the next couple of years. So I think it'll be continued improvement, sort of that trend line of maybe 16, 15% as a longer term sort of customer churn level. But that's sort of where I'm expecting and seeing that. Now, if we think about their marketing spend and efficiency, so the biggest way I model and measure this, the way I sort of work my model is I say, look, I'm seeing an expected top line growth. You can work out your loss ratio from there. You can work out your revenues from there. But then I'm saying to get to that amount of growth, you're going to have a certain amount of customers, a certain amount of premium that churns away every quarter. So you have to overcome that premium that's churning away, plus grow the amount that you want to grow, the overall top line. So you need there's going to be some efficiency in your marketing as you spend dollars on growth spend and you bring in premium. And that's what I'm calling this ratio here, your customer acquisition spend to IFP acquired. And I have it at 2.5 for Q4. If you look at the last few quarters, so the higher the number is better. The bigger the number, if you had a 3, 4, 5, that means you're getting $3 of premium coming in the door. That's what you're acquiring for every dollar you're spending. And so we had 2.5, 2.56, 2.74, 2.37. We had some... you have 1.98 in, you had one quarter back here where if you're spending less, you only spent 20 million on growth spend. We had a 3.51. We actually had in the 4 range because we were spending very little on growth spend, 16, 12 million, 13 million. Spending relatively little versus now you're spending 46 million and you're getting a 2.5. We'll talk about this a little bit more maybe later in the video when I talk about 2026 and what I'm plugging in there. But I think this is a reasonable assumption of where this number will come in at. It's mostly going to be a function of how much dollars you're spending and how many products you have in how many places. It's really just a function of, sort of if you think about the world as a big giant orchard of trees that are growing potential customers. Every quarter, new customers grow, new customers grow, new customers grow. And you want to reach and meet and attract and acquire those customers, pick those fruit off the tree, you have to spend so much on marketing. But if your orchard is only, one tree big, you're going to pick all the fruit, and then every dollar after that's going to be kind of useless. But if you keep growing the size of your orchard, you can spend more on your labor or your growth spend to go out and acquire and pick the fruit. So that's be my sort of metaphor analogy of how you can think about that. They're really the two driving forces. And as you expand your product lineup in more products in more places, and then you're going to increase the size of your orchard. Also, if you lower the costs of your products or you make your prices more competitive, especially to the customers they're going to have, if you can price your customers correctly and accurately, find the most safest, lowest risk customers, especially they naturally have the lowest loss ratios themselves, well, then you can really afford to give those customers better discounts, and you're going to expand the size of your orchard that way, or maybe sort of the amount of fruit on every tree. You can kind of think of it that way, because because in this competitive marketplace, you're grabbing that fruit versus you're attracting and grabbing and acquiring the fruit or those customers over your competitors that are not giving them as competitive a rate. So it's a bit of an analogy there, and that's really I think all the dynamics and forces that are going to move this number around. But it's a really important number because it's really important to model this number accurately, I think, in the future, what your conversion rate is, because that really affects, look at how much this year they're going to spend $180 million on marketing. Massive. I'm modeling for next year $212 million. Like, this number is going to keep climbing. 2027, I haven't looked at this as closely, but $270 million. So that number is going to keep growing. They're going to eventually spend billions of dollars a year on marketing, because that's what it takes in a noisy world to basically to go out and acquire your fruit. You have your orchard, you got to go out and pick it. And so, and of course, there's other variables that affect your sort of effectiveness of picking the fruit out of your orchard. Would be other things like how creative can you be with your branding, how interesting, and just how interesting is your brand, is your product, how much sort of a big of a splash and publicity are you able to make? So, things like the announcement with Tesla, they're doing this full self-driving, LMND is doing this full self-driving, offer where if you're, I think it's only in Arizona to start, but it's going to expand to more states. If you're driving miles on full self-driving, you get half the price that normally you'd pay, because you should be a much safer driver on full self-driving. But that also made a huge splash of just general interest in Lemonade. People are still talking about that. I think that's going to continue to be referenced and talked about, and those sort of things make a big splash and are really will materially move the needle for the company especially in the coming quarters as we look to 2026 and beyond, as they're able to generate organic interest, free publicity. So anyways, that's some of the marketing spend. I had $46 million at a 2.5 ratio there. If we look at some of the other factors here, I have other insurance can really bounce around, but I have it similarly growing a little bit higher, a little bit tech development creeping up 1%. G&A I have flat. This can really jump around, like you have quarters where it drops. You can see it was around 33 million of 35, just creeping up past that. If you look at total operating expenses minus growth spend, it's bouncing around because you have a lot of quarters moving around. But eventually, out into the future, I'm modeling this at like 4 to 5% year-over-year growth. So that's all of your operating expenses except for the growth spend. That's sort of all your sort of fixed overhead to run the company. And then you can think about this as a more of a variable cost, your growth spend cost to push out and grow into the future. So you put all that together, you get Adjusted EBITDA. I'm getting a 9.4 million Adjusted EBITDA result for Q4. If we flip back to where we started, guidance here, I had the better end, it was minus 13, and now I'm at minus 9.4 million. And you could compare, actually, before I jump to comparing that, what this beat would be, maybe I'll look at what would it take if we were to break even in Q4. That's been something that has been thrown around. Will we get a positive result in Q4? Maybe. So what would that take? If you put the numbers in my model, it's something like if you have a 54% gross loss ratio, so that might, if the gross loss ratio the cat is super tiny, like here, the cat's say 1% and this drops to 53%, and then you're at 54% gross loss ratio, you could be, you'll be very close to breaking even. Like might be, it might be minus 1 million. If another way to think about it is if this CAC spend IFP, like somehow car is rolling out and it really kicked off in Q4, and now the size of your orchard's bigger and it's really effective dollars that are being spent, and so you made this a 3, it means you're spending a lot less on growth spend. Only 38 million. You're saving a lot, and then you're only at 1.7 million adjusted EBITDA. So you're also getting very close to that break-even point. I don't think it's realistic. This is very realistic that this would be that good, because then you're only spending 172 million on marketing. Of course, you could push the top line higher, and maybe they grow even faster than the 31% I'm showing, but I don't think that's realistic either. So I think it's more likely that the marketing is going to be kind of in this range, but there could be, of course, some combination between these two. Is, maybe this is like 2.9 ratio even, and maybe your loss ratio, I still think that's probably a little bit unrealistic, but maybe your loss ratio is 7% gross loss ratio, and the way I'm modeling it, like that would get you a positive. That could be really tremendous surprise for Q4 results specifically. Again, I think 2.9 is probably, I'm gonna undo both of those, but let's start with the loss ratio, and let's say, flipping back to here, if this is 50, if the X CAD is 56 and say that it gets down to 54, and then say the CAD is only 2, you might be at like a 56% gross loss ratio. So if I'd say 56%, because I was at 57 before, and then that would get you on its own of 4.3 million, which would be a tremendous result. And if this is higher, say like 2.7, then you're going to be really close to the break even. If this is 2.75, you'll be right there at break even. So it could be in that, that's not what I'm expecting, but I'm saying 59, but or say you move this down, say this is just 55%, the CAT is 1% CAT, and that's even 2.5, it stays the same. Your ratio here is 2.5, that CAC spend. Well, now you're at just 2.5 million. And if this is even just a little bit better, more like what I'm modeling next year, as car rolls out more, you could get to positive. So, I don't think we're going to see that happen, but it's an interesting question. What would it take to get break even in Q4? It's not, I don't know. And what would the odds of both of those kind of having improvement? I don't know. Well, maybe it's I wouldn't be surprised if it's like a 20% chance, something like that. You had that kind of upside surprise, but I'd be less unless there's even a chance, this is worse, right? Maybe I'm too optimistic, and it's 2.35, and you're spending even a little bit more, and you're at 12 million loss, and you're more in line with guidance. So it could swing both ways. Maybe it's 10% chance that you'd have some beat like that. I think that if the market saw that, it would be very impressive, and would be impressed by that. But there's pretty good chance we're under 10 million. And regardless, a theme through this quarter is is a pivotal quarter, and it's good news. It's good news after good news. I know the stock, at least at the time of recording this right now, Thursday evening, Thursday, February 5th, the stock has been really down the last couple of days. But in terms of what I'm expecting in a couple weeks from now or so, when earnings, is really, really positive news all around, everywhere. It's positive. It's like super, super exciting time to hold Lemonade stock. That's why the stock is falling. I'm like, okay, I think the stock's worth, 150 to 250 a share. So even if you took the low end at 150 and now you're saying this, you're going to sell me shares for 75, 70, 60 something a share, whatever the price is going to go to, I don't know. I mean, that's less than half of the low side of what I'm thinking the company's worth. So that's a tremendous deal. That's why I'm trying to get any more shares I can in this window of time, because it's all good news. It's just good news. Good news coming. So good news. Okay. So, all right, now let's look at difference versus guidance. I was going to point out, so I have about 9 million or so modeling. Let me just minimize this for a second. If you look at adjusted EBITDA dollar difference every quarter from what's guided to what they've actually achieved, you can see I'm coming in at about a $5 million beat. And you basically this is how much you're beating it every time in dollars. You're basically always beating it. If you look at it as a percentage basis, this is, I guess I could have flipped the chart around, but this is how much you're beating it on a percentage basis. It's a large percentage I'm predicting, but adjusted EBITDA is shrinking. Your guidance is low, and then you're beating it only by 5 million, so your percentage should be relatively high. As a percentage is less significant revenue. This is on a percentage basis. I have it basically right in line or just barely beating the middle. IFP, you can see historically percentage, you're getting smaller and smaller beats on a percentage basis as the book of business grows, which makes sense because your book gets bigger. But some small beats there. So that's where Q4 is. I think Q4 is going to be really strong. There's a good chance adjusted EBITDA is less than $10 million loss. There's even a possibility, I don't expect it, but there's a possibility it's like minus 1 million or plus 1 million or something in that range, right? Which would be pretty awesome. Now let's look at 2026. This is where things get also very exciting, because specifically I've been saying for months, I think the guidance for 2026 is really going to surprise analysts and people on the market. 2026, starting at the top line, in-force premium, I'm expecting cars rolling out, excitement around Tesla, their full self-driving offer is rolling out and gaining additional traction. I'm expecting it's truly the year of the car, as car is more or less feature complete and really rolling out more and more aggressively. And so they're able to accelerate a little bit faster and get to kind of a 33% growth range. That's what I'm expecting. I don't expect they're going to guide for that much IFP growth. It'll probably be more like 30% growth, but that's what I'm expecting for that. Now, I'm thinking about the loss ratio. Throughout the most of the year, I have a baseline loss ratio, gross loss ratio of 63%. But if you think about Q1, you have this, it's called Winter Storm Fern that happened. You may have heard about it. It didn't make as much news, which is generally actually a good sense if people aren't just average sort of small talking about that as a newsworthy thing, that there was a big storm that caused lots of damage. If you're not hearing about that as much, of course, depends where you are and how close you are to it, whether you will hear about that. Can tell you something, maybe a little bit of a signal about how large the storm would be. The latest estimates I've seen for this storm that just occurred in late January, is that it could be up to $4 billion in insurance losses. If, for example, the storm in 2021, I'm calling the Lemonade called it the Texas freeze. That was Storm Uri, URI. That was more like 15 to 18 billion is the estimates I've seen of sort of total damages from that. So the estimates I'm seeing for this one are about 1/4 of what that was. So, but that storm did cause a significant increase in their loss ratio, but I'm really not that concerned about this one for a few reasons. Because number one, it's the storm itself and damages are probably about 1/4 the size. Another way you can think about this is, ask Grok, how many houses were without electricity from Storm Uri and Storm Fern? And I'd seen some other data sort of roughly posted, which seemed to also align with what this is saying. But it says at its peak, more than 4.5 million homes and businesses were without electricity, primarily in Texas. Lemonade had a lot of, still do, but a lot of customers in Texas. And this one is at its peak more than about 1 million. So again, around 1/4 maybe you could roughly think about it as the damages. Because a lot of your damage from a winter storm, my understanding is going to be caused by people. Their houses are not built and ready. They're not insulated the way, for a really cold climate. The weather, it goes to below freezing, and your power goes out, and they don't have natural gas furnaces or anything like that. So you're just running electricity, and you don't have electricity. You don't have a generator, and some of your pipes freeze in your house. The pipes crack open, and you have water damage and leaking and lots of repairs and damages from that. So, but this is again maybe estimating about 1/4 of the sort of homes without electricity, which would be the homes most at risk, right? And I wrote about a couple things about this storm in my Patreon. By the way, if you want full access to my Lemonade model, more updates from me on other things such as this, feel free to support my channel. Go join my Patreon. Really would appreciate that. There's only, I forget, like 15, 20 more spots for the $5 a month. And then it goes up in cost as we sort of fill up each tier in my Patreon. So anyways, in this article, I made the point it's probably about 1/4 of the damages or so. Also, another way to think about this is Lemonade has a much larger book of business overall. It's than, say, they did in 2021. Its home is also a much smaller percentage of the entire book of business. It was a much larger percentage then and a much smaller percentage now. And they've actively cleaned up the riskiest parts of the business, especially the home portions of the business, and their baseline loss ratio ex-cat is significantly better than it was in 2021. So I think this is a nothing burger. And another way you can kind of quantify what this might affect, if you think about the storm Uri 2021 might have been around like 26, 27, 28 million dollars before reinsurance in damages to Lemonade. If you think about this and say like this is like say this is a baseline next year of 63%, as kind of an average with a little bit of average cat involved in it, and you wanted to add, say there was, they did 28 million before reinsurance in insurance losses from Storm Uri, and now you're talking Storm Fern might be like, maybe call it 1/4 of that, but maybe even less than 1/4 because of those other factors I mentioned, but just call it 1/4. You might say, it might be like 6, 7, 8, 9, maybe 10 million at the worst. I'm saying, okay, if this goes up, this is 201 million sort of as a baseline, and if this went up to 67%, now you might be like 213 million. So it's probably I don't know, maybe you're adding 4% to the loss ratio in Q1, 5%, maybe even less than that. That's the way I'm thinking about it. So that's why I'm saying, this is really a nothing burger. I might even be being too conservative, and this should be even less. Maybe the baseline is actually more like 59%. And of course, we're not out of Q1 yet. We still, we're not even halfway through it, so there could be other events that occur. But yeah, that's overall where I'm kind of placing that. And then 63%, I'm factoring in they're growing more into car. Car might have a little bit higher loss ratio. It's been continuing to trend down, but that's taking a larger portion of the book of business, slowly eating more, taking more of it. But overall, that whole book is also coming down. So I think 63% is pretty realistic. But they... And that's kind of what I'm modeling out for the remainder of the year. Then I talked about this before, and when I talked about Q4, but churn is going to be 16.5%. Actually, no. Another thing to note, I forgot to mention here, pull this up again, is revenue. Why revenue will soar. So insurance is kind of funny because if you use reinsurance and you give some of your premiums away to a reinsurer, then they no longer count those premiums as revenue. But if you start to take on more of that risk yourself and that comes back in the door, then your revenue sort of artificially goes up or down as your reinsurance goes up or down. And you can see reinsurance, they lowered this last year. They announced they're going to drop this down to 20%. And I have that tapering down to 20% by Q3 next year. And so that's going to affect your reinsurance. That reinsurance is going to affect your revenue. And I have a chart here of, I'm going to just minimize, actually, I'll just move this over here. So where your revenue is going, you can see, this goes all the way back to 2019. We've had nice growth here where the growth is inflecting just in 2025. And you can see where they slowed growth down with a lot of really, really heavy inflation over the last few years. And that's been speeding up. And you can kind of see your revenue. This is, this is on a trailing 12-month basis. And starting to pick up, and you'll see this inflection point over the next year. So, for example, I'm at 731 million next year, or next quarter, I should say, and then we go to 1211, and so if we pull up just 731 divided by 1211 divided by 731, you're at 65% growth in revenue. So that's going to be, we've had a bit of when they've increased reinsurance in the past, that could have made your revenue numbers look worse artificially. And now as you decrease reinsurance, you're also seeing your revenue numbers increase. We look at the marketing spend. I touched on this too, but I have 2.65 as that ratio of IFP acquired to CAC spend for the year. Now, if I could try and quantify that a little bit more, 2.65 as you're spending. Here's a graph of what they've spent in a quarter and how much IFP they've acquired. You see in past quarters they were much less effective because the size of that metaphoric orchard was much smaller, and you really didn't have a lot of availability for even the amount you were spending. Then they really sucked it down. They spent a lot less, and then those dollars you are spending is much more effective. And now they did that because inflation was so bad. And now with that rates fixed, loss ratios where you want them to be, now they're really batting in this area here, kind of the strike zone. And if they start to push this into the 50 million plus range, but I'm still projecting they're still going to keep hitting in this sort of 2.65 as the size of their orchard grows. They have more products in more places. So that's what I'm modeling, that 2.65. Also, another way to think about this whole scenario is if you look at your LTV to CAC, lifetime value of a customer to customer acquisition cost of that customer on a trailing 12-month basis versus what you're spending in growth spend. And this really tells us a story where you can see the company floundered more. LTV to CAC was pretty low because the customers loss ratios were too high. And then as loss ratio, they slowed down the amount they're spending on growth. They came over here. They were prudent. They slowed it down, and they kind of walked up here. And then these are the most recent quarters, Q3, Q2, Q1. Here the arrow, they're dancing, and there'll probably be another in this range, and then probably push. I bet you, Q4 will probably land right in here, and then next year we'll push higher as loss ratios further to the right as they spend even more on marketing, but they still have strong above 3 LTV to CAC unit economics. So another way to think about it that brings in all of the sort of lifetime value of the customer versus purely this, if you're looking at this, you're only considering how much IFP, how much premium you're getting, and not sort of the actual gross profits you get from that customer. Another reason why I think the marketing spend, even 2.65 that I'm marketing for that ratio is maybe low, is because you just look at this graph of Lemonade car insurance for the last 5 years and look at the crazy spike we had. That is crazy spike we had as interest in the Tesla full self-driving product occurred. So you just have a ton of people that suddenly maybe never heard of Lemonade are hearing about Lemonade, talking about Lemonade, and it's still continuing to make news. So get that free publicity and free interest in your product. I think that's gonna actually move the needle on the marketing spend. And so, yeah, and you can kind of see, obviously, it spiked up and then came down. That was right when the announcement was made. Elon Musk had a tweet pinned to his X profile, and it literally was just the tweet was talking about Lemonade and how they're offering, full self-driving miles at half the price. But you can see the underlying trend continuing to sort of like rise up from beneath that. If you look at Lemonade pet insurance, same story. We've had different spikes along the way, but it's still underlying, continuing to push up. Lemonade insurance as a whole, again, we have different spikes, some that are seasonal, certain events, certain things that have occurred, that it's continuing to push up. So general interest should go up as they're spending more on marketing, but I think there's also other events that are pushing interest in the company up. So what I'm modeling there, let's see, I had that graph there. What I'm modeling there is for, 2.65, I really don't think is crazy. And, I wouldn't even be surprised if this, with those different factors and pushing more and more into car, this was significantly larger. Because people don't really understand, you talk about the size of the orchard, go back to that analogy again. Pet renters, they're like if you look at U.S. pet renters, are like 5 billion, premium markets a piece, something like that, in in that sort of ballpark. And then car is like 300 billion. So it's like, what is that? It's like 60 times the size of pet or renters. It's like 60 more pet insurance markets that they just are entering. 60 more, like that's significant. That's very significant. So, and of course, and plus they're even in Europe and they're expanding they're growing significantly there, and I wouldn't even be surprised if they, if they got an announcement, they entered, say, Ontario, Canada, and entered that market, or, other markets. So you're always expanding the size of that orchard, then this can stay at a very healthy ratio or go even higher. I talked about this before, but I have, some of my other expenses, like other insurance expense growing 2% quarter over quarter, tech also growing 2%, G&A sort of some mixed growth in there, I threw in there. And yeah, you get to bottom line here, I'm getting to adjusted EBITDA of minus 20. Move this down to adjusted EBITDA. Minus 20 for Q1 with a little bit higher loss ratio. And then Q2 is minus 3.8. Q3, I have a first positive quarter, just barely positive. And then Q4 is more like plus 9 for the entire year. If I show that, I'm at minus 12 million on the year. Very well, this could even surpass or be better. Maybe my loss ratio is too high with the storm. If this is, if this is 64%, let's bump that down. Now I'm at 14 million. I'm at minus 6 million for the year. What would it take to get to, I'm just going to move that back for a second and then say these were all 61% average as a rough average. You could be positive even in Q2 and you could be positive for the year at 4.8 million. So it kind of depends. Probably big effect at what loss ratios continue to come in at. Maybe they're giving some pricing sort of back to the customers. That's certainly a possibility. But this is really exciting. This is really exciting because even at the state I'm modeling right now, you're at $12 million loss. And I had this post, I want to talk about the history of Adjusted EBITDA guidance, because it's a big question is like, what are they going to guide and how's that going to look to the market? My theory has been for quite some time that this is really going to surprise the market, because if you look at it over the last 2 years, this is the start. Where was the Q4 results and then 2026 guide? The guidance for the year at the start of the year, Adjusted EBITDA in 2024 was $157 million loss. 2025, $137 million loss. So if you just look really surface and you're looking at this company, you're like, that's not very impressive. Like, even on an Adjusted EBITDA basis, you're losing $157 million. Like, that's a lot. And then 2025, well, you made some improvement, but it's still $137 million. So, like, where the profit's going to come? That's basically what it's going to be. And I tweeted this out back in December and was saying, it's probably, I said -10, and it may be better than that, to maybe -30, depending on how conservative they guide. And even if they guide, so I'm saying, I'm modeling maybe -12, and I'm saying, they might even break even depending on loss ratios for the year. And I don't think they're going to come out and guide and say, we're going to break even for the whole year. I doubt it, because they have a history of being very conservative. And maybe they're more conservative than -12 million. But even if they guide to -30 million, you look at the trend line, -157, -137, -30. Like, that, it's really obvious that there's a shift in the trend. And these years, these results have only gotten better, both of them, throughout the year, so even if they said -25, -30 million, the market's going to say, they'll probably significantly beat that through the year, through 2026. That's kind of like, you're at this point where, there's a risk that they guide too conservative, which they have in the past. And I hope they don't just think, we got to be super extra conservative because the market can't know that for whatever, we got to make sure the market's scared or something. No, I don't think they would do that. And that doesn't make any sense. And that wouldn't make sense to do that. They have a history of trying to be accurate and then skewing strongly conservative. And so if you think accurate is, -12 million, say what I'm modeling, and then strong conservative is saying, we're going to pad that and say it's -30 million. Well, it's still only -30 million when the years before you guided 157, 137. Let's flip back to our guidance for this whole year is 130, 127 million. Like, they'll beat this probably by 5 million or so. But still, you're still 120 million in 2025 result, and now you're going to go from that kind of a loss to maybe -30 million loss as their guide, and then they'll actually probably significantly beat that. I still think it'd be pretty hard for them to make that so conservative that you spook the market. You'd have to guide -80 million, and it's I don't see how you could possibly get there. If they guide for -80 million, I'm they can do whatever they want, but I would not be impressed, because it'd be that makes no sense unless they plan to grow 50% a year, and they're raising money, and they're gonna just spend crazy on marketing and grow way faster than we even thought, and then the marketing is gonna take longer to pan out, and you see the profitability coming from it. That'd be the only scenario that would make any sense. Otherwise, that would make no sense at all. And and they're not dumb, so I don't expect we're going to see that or that's going to happen. So this is a really pivot. Can I talk? Pivotable thing. Whatever. It's going to be a really important moment in the history of the company. I mean, mark my words on that. I think because this is a huge turning point. And like I threw in some on the text here on the side, like even if you went to 60 cents, 66% gross loss ratio, that still gets you to minus 35 adjusted EBITDA. And even if that's 66% and 2.5x marketing ratio, which I think both of those are still too conservative. Like I don't think those are realistic numbers when you're rolling out CAR, that you're only going to be 2.5 and it's only going to be 66 when you're underlying. You're probably going to make like a 59% in Q4. You get to maybe a 48 million. That would be like the very worst, and that would be, in my mind, really pessimistic. Like it doesn't even really make sense because they've said they're going to have at least profitable quarters. So like if I change this to 2.5, for example, and I'll just go like this, paste it over, and said the gross loss ratio was 66 just across board here roughly. You'd be adjusted EBITDA, you're at minus 50, depends on which, if I may change this, it would probably to 66%, it would also improve that. But that doesn't even really make sense because you're not even hitting any profitable quarters, and they've been telling us for years 2026 is going to be the profitable year. So, yeah. So I'm gonna hit undo, move those numbers back to where I had them. But I think realistically, if I had to give guidance, and you wanted to be conservative, I might say like, yeah, maybe it's 20 million adjusted EBITDA loss is what they tell us. And that's going to, again, it's really going to slap the market in the face because you went from minus 137 million now to the next year it's minus 20. Like can't tell me there's an underlying trend then that's taking place, or it's really obvious to the market and even skeptics then at that point. And I've been harping on this. I looked back. This was since July 5th of 2025. Where I kind of realized, like, yeah, at that point I had $6.9 million loss for 2026. And now I'm saying, maybe it's 12, maybe it's in that range, depends what you plug in. It's going to be good. It's, as I said earlier in the video, is a lot of good news because even though the stock has been crashing, it's like one of the most exciting times as a lemonade investor. And so that's why I'm not even bothered that the stock is crashing. It's crazy. Let's move. That's where I'm thinking, 2026 is going to come in. Why it's this really critical turning point. Another thing I want to talk about and explore a theory here is what the price might do. So on my Lemonade Patreon Discord here, there was a post a little bit ago back in January. I'm going to minimize this. That said, typically, he just made the argument that typically that January, February are positive. There's sort of a trend over the last 3 years. There's positive sentiment and then moves up into Q4 full year earnings. And then there's negative sentiment as it moves down until Q1. Pricing bottom in April, May, June, driven by sentiment after Q1 report. Peaks in late June, July. Q3 24 clear price drop after Q3 earnings. It says price bottom in September, blah, 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 because, of course, he said there's one-off events that have had major, effects on the stock price, but otherwise it's sort of played the same pattern that management has been very more cautious than the market expects, and they're very conservative in their guidance, and then Q1 and Q2 have maybe higher CATs, and so their loss ratios look worse. And then it gets better as the year goes on. You're also spending more on customer growth in Q3, and you're ramping up that growth spend even in June. So it makes Q2 look worse for that reason. But then in Q3, Q4, you have some relief, and you see some you see more of the effect and fruits coming from your marketing spend. So he's saying, he's kind of making this argument like it's interesting. There's been some pattern here. I think it's it's an interesting thing to consider. And 2026 could follow or be different. I have no idea. And he is right. Like if management comes in and says, adjusted EBITDA for this for 2026 is 60 million, well, it's more like the market didn't get slapped in the face. It kind of got, lightly poked in the face. Like it's not as significant, as shocking, as obvious. It is still it is still an obvious trend, but it's not as strong a trend as you'd hope for. I think that would again be super conservative. Maybe that's what management's going to do. We'll see in a couple weeks, but I kind of feel like this would be different and will break the pattern, just because that kind of a 60 would be so unrealistic to model like that. Even okay, I'm just throwing around some thoughts here, but even what I'm saying is 33%, growth. Even if I dialed that back and that was a 30% growth, you would, if that was 30% growth, you'd spend, if you have the same sort of unit economics otherwise, you'd actually spend less on marketing in the year, and your adjusted EBITDA would rise. So it would make at least your bottom line, your top line growth might be slightly less, but I still think it's going to be like, 30, same as this year, better, 31%. But then it makes your bottom line, if you model that out, to make your bottom line look better. So then how would you even push? You'd have to be like even extra conservative in your guidance of your bottom line to make that even make any sense at all. So to my mind, I think we're bucking this trend. This is the pivotal point, and things are going to change here where the market, they might still be conservative and say $30 million adjusted EBITDA loss, but it's like shocking, where it's shocking the market and really showing it, making it obvious where this is headed. At least that's my thoughts on that. And I don't know what the market will do, with those results. But from a price perspective, I'll just flip to stock price. Obviously, the stock price, this is really zoomed out here, but we had a really nice rise. For like a day, we touched 100, felt amazing, and then we dropped now down into 60. It's looking like 60s. Might be headed there. We'll see what happens. I still think the stock, if I flip back my model, I still think, depending, what PE you give and how you look out, how far away you look, but you can easily say the stock is worth $150 to $250 a share. And so if I can buy, if it's less than half of the lower end of that range, it's a tremendous deal in my mind. And I think at some point the market's going to catch up on that. Maybe it's this earnings, maybe it's immediately after, like we've had some violent moves. There's also kinds of crazy macro uncertainties right now that could change. Even earnings is still like 2 weeks away, so that could tremendously change. What I'm saying is I don't know, no one knows, but I feel, and from a business perspective, I think everything is good news for Lemonade. Everything about this quarter is good news. Good news. One more thing we could throw in here is there's an earnings estimate. This is kind of interesting. You look at what analysts are looking at for revenue. So the average revenue for, say, 2026 is $1.16 billion, and the high end is 1.25. So 1.16 and 1.25 being the high end. If I look at my revenue, I have 1.210. So I'm right close to the higher end of that, but certainly above where the average would be. And if we look at from an earnings per share perspective, average is $1.64 loss, and high is $1.37. So $1.64 and $1.37. And if I look at my earnings per share, I have $1.30. So I'm a little bit better than even the higher estimates there. And so again, not way out to lunch from what analysts are saying, but it's significant. I think we'll be beating them, consistently beating what they're expecting, even especially at the average side, but even at the high side. So exciting times for Lemonade. I hope you found this video helpful. Again, feel free to join my Patreon and you get full access to this model. There's only 16 spots left for this early investor space, and then it will be sold out, and then it'll just go up to the next tier, which is $5 US a month. So it's really not that much. And yeah, which is cool. But thank you to everybody who supported me there. Thank you so much for watching. And remember, it's in the bag.